Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of the ultimate guide to emerging markets investing in 2024. Emerging markets offer some of the most exciting investment opportunities today. Picture yourself tapping into the economic growth of countries like China, India, and Brazil. These regions are seeing rapid advancements, making them hotspots for savvy investors. Investing in these markets can diversify your portfolio, enhance your risk profile, and potentially yield high returns. However, it's not without its challenges. Geopolitical risks, currency fluctuations, and regulatory hurdles are just a few. So why bother? Because the rewards often outweigh the risks, especially if you're informed and strategic. In this video, we'll explore the essentials of emerging market investing, helping you navigate this dynamic landscape with confidence. You'll learn key strategies, understand the risks, and discover how to seize the opportunities that these markets present. Stick around, and let's get started on your journey to smart investing in 2024. What are emerging markets? Emerging markets are economies on the brink of rapid growth and industrialization. Unlike their developed counterparts like the US or Germany, these markets are still evolving. Investing in them can be like catching a rising star. They offer a unique mix of fast-paced economic growth, young populations, and potential for high returns. Characteristics of emerging markets. What sets emerging markets apart? Let's break it down. Rapid economic growth. One of the most striking features is their high growth rates. Countries like India and China have shown GDP growth figures much higher than those of developed markets. This rapid expansion creates numerous opportunities for businesses and investors. Young and growing population. Emerging markets often have younger populations compared to developed countries. This means a larger workforce and consumer base. A young, growing population drives demand for goods and services, making these markets ripe for investment. Increasing urbanization. Urbanization is another key trait. As more people move from rural to urban areas, the demand for housing, infrastructure, and services increases. This shift offers companies a golden chance to tap into new markets. Underdeveloped infrastructure. While this might sound like a downside, it presents investment opportunities. The need for roads, schools, and hospitals means there is a demand for companies that can provide these services. Investing in infrastructure projects can yield substantial returns. How they differ from developed markets. Emerging markets are not just smaller versions of developed markets. They have distinct features and offer unique investment avenues. Higher volatility. Emerging markets can be more volatile. Factors like political instability, currency fluctuations, and changes in government policies can create uncertainty. This can lead to sharp market movements, both up and down. Regulatory environment. The regulatory environment in emerging markets can be less predictable. Rules can change quickly, affecting businesses and investors alike. However, those willing to navigate these challenges often find lucrative opportunities. Diversification benefits. Adding emerging market assets to your portfolio can enhance diversification. These markets often have different economic cycles compared to developed economies. This means they might perform well when developed markets are struggling, reducing overall portfolio risk. Why consider emerging markets? Why should you, as an investor, care about these markets? The high growth potential is the main attraction. As these economies expand, the opportunities for profit grow. Companies in emerging markets can surge quickly, offering significant returns. Moreover, emerging markets provide a way to diversify your investments. By putting some of your money in these markets, you are not only spreading risk but also tapping into a different growth engine. Emerging markets are dynamic, challenging, and exciting. They offer a world of investment opportunities if you are ready to embrace the risks and rewards. Stay informed, make strategic choices, and you can potentially reap the benefits of these growing economies. The importance of emerging markets in the global economy. Emerging markets play a crucial role in the global economy. Their rapid growth, young populations, and rich natural resources make them vital for investors and businesses alike. Let's explore why these markets are so important. Economic growth potential. Emerging markets often boast higher growth rates than developed economies. Countries like India, China, and Brazil have been showing strong economic performance for years. Their GDP growth regularly outpaces that of the US and Europe. This rapid expansion presents numerous opportunities for investors and businesses. High growth rates mean more business opportunities. Companies can expand their operations, hire more workers, and increase profits. Investors can tap into this growth through stocks, bonds, and other financial products. In short, the economic potential in these markets is enormous. Demographic advantages. Emerging markets enjoy significant demographic advantages. Many of these countries have younger populations compared to developed nations. A young workforce means a larger pool of employees and consumers. For businesses, this translates to more people to hire and sell products to. Urbanization is another key trend. As people move from rural areas to cities, the demand for housing, infrastructure, and services increases. This shift presents golden opportunities for companies in construction, retail, healthcare, and other sectors. Some of the key demographic trends include younger populations, with a median age that is often much lower than in developed countries. Urbanization. More people moving to cities, creating demand for modern infrastructure. Increasing middle class. As economies grow, so does the middle class, boosting consumer spending. Natural resources and innovation. Emerging markets are rich in natural resources. Countries like Brazil and Russia have vast reserves of oil, gas, minerals, and other valuable resources. These resources are crucial for the global supply chain and drive economic growth. For investors, companies in these sectors can present lucrative opportunities. But it's not just about natural resources. Technological innovation is also booming in these markets. Many emerging economies are becoming leaders in new technology and innovation. For example, China has become a global leader in e-commerce and fintech. India is known for its IT services and software development. Investing in these markets means tapping into both their natural wealth and their technological advancements. It's a double advantage that can lead to substantial returns. Emerging markets are dynamic and full of potential. Understanding their role in the global economy is key for any savvy investor. Remember, these markets offer a mix of high growth, young populations, and innovation. Keep these factors in mind as you explore investment opportunities. Benefits of investing in emerging markets. Investing in emerging markets can offer unique opportunities that you might not find in developed economies. Let's explore the benefits that make these markets so appealing to investors. High growth rates. Emerging markets often experience higher economic growth compared to developed countries. This can translate to substantial returns for investors. For example, India and China have seen annual GDP growth rates that far exceed those of many Western nations. In recent years, India's growth rate has hovered around 7%, while China's has been around 6%. These high growth rates can lead to profitable investments, making emerging markets very attractive. Diversification benefits. Investing in emerging markets can diversify your investment portfolio. By spreading your investments across different regions, you can reduce risk. Here's how. Different economic cycles. Emerging markets often operate on different economic cycles than developed markets. When one is down, the other might be up. Reduced dependence. You aren't relying solely on the performance of developed markets like the US or Europe. Diversification helps to smooth out the bumps in your investment journey. Even if one market performs poorly, others might do well, balancing your overall returns. Access to new consumer markets. Emerging markets are home to growing consumer bases. As these countries develop, more people enter the middle class, leading to increased consumer spending. Take Brazil and Nigeria as examples. Brazil. Known for its youthful population and growing middle class, Brazil offers opportunities for companies and investors in retail, technology, and healthcare. Nigeria. With a rapidly expanding urban population, Nigeria presents opportunities in sectors like telecommunications, real estate, and finance. These new consumer markets can drive high demand for goods and services, opening doors for businesses to expand and grow. Investors can tap into this growth through stocks, mutual funds, or ETFs focused on emerging markets. Risks associated with emerging markets investing. Investing in emerging markets can be like navigating uncharted waters. While the potential for high returns is alluring, it's crucial to understand the risks involved. Let's break down some key risks associated with investing in these volatile markets. Political and economic instability. One of the biggest risks in emerging markets is political and economic instability. Changes in government, corruption, or civil unrest can create an unpredictable environment for investments. Take Venezuela, for example. Political turmoil has led to severe economic downturns and hyperinflation. Investors faced massive losses as the country's economy spiraled. Similarly, political changes in Turkey have led to market volatility, impacting investments negatively. Here are a few ways political and economic instability can affect investments. Changing policies. New governments may introduce policies that impact business operations and profitability. Economic crises. Sudden downturns can erode investment value. Social unrest. Protests and strikes can disrupt business activities and reduce investor confidence. Investing in emerging markets can offer high returns, diversification benefits, and access to new consumer markets. These economies often have younger populations and higher growth rates, providing unique investment opportunities. Stay tuned for part 2 and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.